High interest rates put pressure on stock markets as the era of low rates comes to an end. August 18, 2026. Global stock markets are facing a more challenging environment as long-term government bond yields in the United States and the Eurozone have risen to levels not seen since the global financial crisis. On August 18th, the yield on 10-year U.S. Treasury bonds rose to around 4.74%. The increase has made government bonds more attractive to investors, while investments in stocks are facing greater risks. A key indicator is the equity risk premium, which compares the expected return from stocks with the return on lower-risk government bonds. This gap has narrowed significantly, particularly in the U.S. stock market. This means investors are receiving less additional return for taking on the higher risks associated with stocks. Pressure on markets is also increasing as higher energy prices and uncertainty in the Middle East raise concerns about inflation. These factors can make central banks more cautious about cutting interest rates, meaning the high interest rate environment could last longer than expected. Higher interest rates also increase borrowing costs for households and businesses, potentially reducing spending and investment. For governments, higher interest payments on debt could also limit their ability to stimulate economic growth through public spending. However, high bond yields do not necessarily mean that stock markets will fall immediately. History shows that stocks can still generate returns during periods of high interest rates, although market volatility is generally likely to increase. For investors, the shift suggests that the era when low interest rates and low bond yields help drive investment into stocks is coming to an end. Going forward, investment decisions may place greater emphasis on corporate earnings, economic conditions, and overall market risk.